Hi, I'm James Robinson, and this is my stock pick of the week. This week's stock pick is The Children's Place, symbol PLCE. Before we go any further, I'd like to invite you to follow me on Twitter. My handle is @RobinsonStocks. Because it takes time to make these videos, I don't always post exactly what I'm doing in form of video. Oftentimes I'll simply tweet about it. So for real-time information on trades, updates on when new videos are posted, as well as news and thoughts on the market and stocks in the portfolio, follow me on @RobinsonStocks on Twitter. In this video, we're going to do an overview of The Children's Place. In future videos, we'll talk about the operations, debt, dividends, and wealth creation factors of The Children's Place. The Children's Place operates as a children's specialty apparel retailer. The company operates through two segments, The Children's Place in the US and The Children's Place International. It sells apparel, footwear, accessories, as well as other items for children, and designs contracts to manufacture and sells merchandise under the proprietary The Children's Place and Baby Place brand names. As of February 2nd, 2019, the company operated 972 stores in the United States, Canada, and Puerto Rico, and 217 international points of distribution operated by its 8 franchise partners in 20 countries. It also sells its products through childrensplace.com, an e-line store, and to give you a sense of scale, about 35% of their sales come from the online store. The Children's Place Inc. was founded in 1969 and is headquartered in Secaucus, New Jersey. It has 15,800 employees. Children's Place just paid about $76 million to acquire the rights and intellectual property of Gymboree, a now defunct clothing line with strong brand recognition for parents. The plan is to sell Gymboree labeled clothing through a unique website for Gymboree, as well as through the Place website and through a store within a store concept in 200 of their locations. The company has also identified 40 previous Gymboree locations which were both profitable and which do not currently have nearby Children's Place franchises. One of the reasons I'm interested in this company is I think this Gymboree thing is a good idea. Gymboree, you may remember, was a store company with about 900 stores, ran into financial trouble, was run poorly. Those stores were shuttered in January. And so you say, well, why is buying a bad series of stores a good idea? They didn't buy the stores. They simply bought the brand name Gymboree, as well as intellectual property and marketing knowledge. And so I think that because of that, they get all the benefits of Gymboree without taking on all the baggage. So I think it can only be accretive to profits. And that's one of the reasons why I'm interested in this company. As of December 26, 2019, the company had a market cap of $953 million. It had revenues of $1.89 billion, profits of $61 million. It had a PE ratio of 16.5. It had a yield of 3.52%, and the company has no debt, or virtually no debt. It's interesting when you look at this company is sort of the best and worst of worlds in terms of a stock that I would buy. In terms of the best, in terms of company management, I give this company a 4 in every category. I've never done that to my knowledge in another company. They do a great job with retained earnings. They basically have none. Their obviously return on retained earnings is great then because they aren't retaining any money. They don't have any debt. They pay good dividends, and the dividends have gone up. They've got their shares outstanding decrease every year. They have good returns on assets and good returns on shareholders' equity. So those are things that I really like about the company. Also, it has no debt. The downside for the company is that its operations are only slightly above average, and normally I would never buy a company with this sort of operations. But because it has no debt, and because I think it's a retailer that can survive, and because the company has this fantastic management, which is so focused on giving money back to the shareholders, I think it's a good stock. And what's interesting is it's the 27th highest rated company out of the now 919 companies that I've analyzed. So it's a really highly rated company, and its stock has just dropped 23% on a bad earnings report. Again, I don't look at quarterly earnings really hardly at all. I recognize there's going to be good quarters and bad quarters for companies. I just look at the long-term growth of the company, and so I'm willing to overlook what happened in the quarter. And I think I'm buying this company at a significant discount as a result of that big drop. So in summary, for the overview of The Children's Place, I want to start off by making it really clear. I generally don't like retail stocks. I generally would not suggest you buy one. It's just too easy to buy online, and when you buy online, it's so easy for everybody to put their wares in front of you simultaneously, and that really kills the margins for retailers who are sort of expecting you to buy when you're in their store without shopping all over the place looking for better deals. But there are some things that I think you're very much more likely to buy in person, and I think a logical argument for that will be children's clothing. You got to remember, with kids, they're growing so fast. The clothes that you thought would have fit them 6 months ago certainly won't fit them now. And so you're constantly trying to find clothes that fit them. And in the process of finding clothes that fit them, you're going to find something you think is cute. And if you find it's cute, you like them, and they like it, you're just going to buy it rather than go home and shop for it. At least that's my theory. And if you decide you want to go home and shop online for it, then Children's Place has an online store which will be happy to sell it to you. So between the spur of the moment, the fact that grandparents are buying this stuff, based on simply its cuteness, the fact that with kids' clothing store, you've got to find something that fits, and you got to buy it really now when you find it. I think that children's clothing is an area that does okay in terms of, will continue to do okay in terms of brick and mortar retail. But if you don't accept that argument, if you think that all retail is dead, then run, don't buy the stock and ignore me. The operations for the company are not spectacular, but I say they're not spectacular. That's not spectacular in the universe of the types of companies that I really like. Generally speaking, this company doesn't do poorly in terms of operations. It just doesn't do excellent, and I tend to demand excellence when I'm analyzing a company. Having said that, it pays a very nice dividend, 3.5%. They've got significant amounts of stock that they buy back every year. The company has effectively zero or negative retained earnings for the last several years, and they're in the top 10% of companies that I look at in terms of return on investment and return on assets. Also, the company just paid cash for the rights to the Gymboree names. I like that they paid cash. When you write a $76 million check out of your funds, out of your hard money, I think you tend to have done your homework and you're really comfortable with what you're doing. And that's not the same thing as borrowing the money from the bank or from shareholders. You're actually reducing the value of your reserves by $75 million when you do this. And I think that they've done their homework. And again, the company's recently dropped 23% about a week ago. And I don't think, based on the long-term trends of this company, a 23% hit is justified. I think that's a bad quarter. I think people are panicking about the Gymboree thing, and I feel the opposite. So I'm very comfortable suggesting you should buy this stock, which I have done today.